If you're curious about the first home savings account, then you're in the right place because today I'm going to talk about the FHSA and how you could use it for tax savings in 2024. And even if you're hearing this in 2023, there may be a reason you want to consider doing it now. I'll talk about that towards the end of the video. You definitely want to check that out. This video is based on information that can be found on canada.ca, which goes into greater detail about the FHSA and how it works. So, come here, get a brief overview, and if you have any questions, you could go there. And ultimately, if you have questions beyond that, reach out to myself or a financial planner just to get some more information. Now, what is the FHSA? Well, it's a registered plan, but specifically it's designed for prospective first-time home buyers, which would allow them to save for their first home in a very tax-efficient manner, right? Now, they're subject to certain limits, but for those who can take advantage of it, there's definitely a tax-efficient aspect of it, which we will talk about shortly. Now, maybe you haven't heard of it, or maybe you just recently heard of it. Well, here's the thing. It's relatively new. It started this year, April 1st, 2023. So if you haven't heard, you're probably busy with family, kids, businesses, and everything else. But started this year, and there's a good reason why you want to consider maybe investing this year or at a minimum next year if you see yourself as a first-time home buyer, or you want to help someone who's like your child or grandchild who's a first-time home buyer. We're going to talk about all those reasons shortly. Now, let's talk about eligibility. The person who can open an FHSA has to be a resident of Canada, must be between age 18 and age 71 years old as of December 31st, right? So we have some limits there. And in terms of first-time home buyer, what does that mean? What's the definition? Well, you're considered a first-time home buyer if you haven't lived in a qualifying home during this current year or the previous 4 calendar years, right? So, for example, 10 years ago you had a home and you no longer do, then obviously you wouldn't qualify, right? So, again, if you have any questions about that, you may want to reach out to a financial planner or somebody who has some understanding of this just to make sure that you qualify. Now, as you set up this account, so you know you qualify, you're going to set up this account, here's a bit of an estate planning tip that you may want to consider, and that is you may want to nominate your spouse or your common law partner as a successor for the FHSA. And that's because, heaven forbid, if something were to happen in event of your death, and that spouse, the common law spouse, or your partner, if they meet the eligibility, then the funds will be transferred over to them. If they don't meet the eligibility, then what will have to happen is that the money will still go to them if they're a beneficiary, but it's potentially going to be subject to withholding taxes, right? But this is something to consider as you set up the accounts. The bit of estate planning tip right here. Okay, so we set up the account, we nominate a beneficiary. What's next? We'll talk about contribution. The annual contribution limit is $8,000 with a maximum lifetime of $40,000, right? So, depending where you're at, you might say, well, that's not enough. That's not a lot. But listen, at least something, and it's more helpful than it is not helpful, especially when you get to the tax benefits of it. So, I get it. Some folks that I've spoken to about it have said, well, it should be higher. But hey, it's still at least $40,000 that goes towards a down payment. So how does it work? Well, tax-free contributions for 15 years, right? If we want to be more details, there are tax deductions for those contributions, right? So it's tax deductible, like an RSP. I think that's the great part of the RSP, at least the similarities with, to an RSP, which I think is phenomenal. And then once you've gotten the tax deductions and that money goes into the account, the earnings from those investments grow tax-free. And that's where they've taken elements from the TFSA, right? Because the TFSA, if you don't know, when you put money in a tax-free savings account, it grows tax-free. So I kind of look at it to some extent, it's the benefit of both worlds. And then when you do pull money, if you take the money out for your first home purchase, then you're exempt from taxes, right? So I think, they've taken the best of all these different programs, because the withdrawals from the home purchase, to me, it's similar to the the home buyer's plan, right? So they're taking elements of the RSP, taking elements of the TFSA, they're taking an element from the home buyer's plan. So I think it's great. Timing of the deduction. So I make a contribution. No. Do I have to take the deduction? No, you don't have to take the deduction. No, you could take the deduction in a future year when you know that it makes, great financial sense. So for example, you contributed this year, but your income, is pretty low, maybe because you're out of work for a certain amount of time, or, took time off, or business didn't do well, but next year, things are going to be much better. You could delay taking advantage of the deduction this year and wait till next year and, take the deduction then. Contributions can be carried forward and claimed in a future year, which is kind of what we're saying. So that's a huge benefit of it. Now, here's what I think. How do I fund this? Do I have to do it with straight cash? No. What you can do is you can use an existing RSP and transfer it over to your FHSA, and you could do that without any type of tax implications, right? So if you already have an RSP, there's an opportunity to use it here. Now, you may say, well, I already have a home, but I have kids and I have grandkids and I want to help them with getting a home. Well, if you already have a home, you could contribute to your child's or your grandchild's FHSA, and that will allow them to earn tax-free investment income, right? So there's an opportunity there. And if you're maxed out, you could also contribute to your spouse or your common law partner. So we see some flexibility there, the benefit of that. Now, a lot of people are going to say, okay, is the home buyer's plan still relevant? Because I know we could do that with an RSP, and we could withdraw up to $35,000 from that. And I say, yeah, it's very much relevant. What you could do is now you combine both. You could max out the FHSA, you get $40,000, and then you could also pull from the RSP under the home buyer's plan for $35,000. And now what you have is at least $75,000 that goes towards purchasing a home, right? And again, conversations I've been having with some folks is that $75,000, depending on where you are, it's not enough for a down payment, and I completely get it. However, it is at least helpful, and it's a $40,000 additional in contribution to your home purchase that you would have earned with, in a tax efficient manner. So there's opportunities there. No, what happens if after 15 years you've said, you know what, forget this home thing, I didn't want to buy a home, or I don't want to do it till later on, or maybe you're approaching age 71. Well, if you don't purchase a home, you could transfer your FHSA funds over to your RSP or your RIF. And this transfer can boost your retirement savings without affecting your RSP contribution room. So right now there are no penalties for that. So I think that is phenomenal. So yeah, that's an opportunity that you can do. Now, why may you want to start to act promptly and start to think about doing this as soon as possible? Well, the yearly limit for the carryover is $8,000, right? And so the maximum yearly contribution is $16,000. So you don't want to wait too long and lose years. The other thing is the accumulation of contribution space begins when you open up a FHSA. So it's advisable to open an FHSA this year, even if you don't plan to contribute a huge amount right away. You want to at least get the account going so you have the contribution room, and have that contribution room grow. So over time, what you can do is, if you can't contribute this year, but next year, what you could do is, okay, if you have enough, make up for lost time. What doesn't work is if you don't open an account, then you just wouldn't have gotten the room at all, right? So hopefully this was helpful. Again, this is a high level. If you have any questions, drop it in the comments. Additionally, if you want to go to canada.ca and find more information, I have left that link below. And listen, this is a new account, and so maybe you now have this information, but you probably know tons of people who would benefit from hearing this. I invite you to share it with them, and then like and subscribe. That also helps. Have a wonderful day, have a wonderful week, and I will talk to you soon. Take care.